Good afternoon, everybody. Check, test. I want to welcome you all to our Lunch and Learn today. I first want to start by introducing some of our sponsors. We have a sheet in front of you with our complete sponsors, but the ones I'm about to introduce are actually attending today. Our first one is Kendall Law, Eileen Kendall, who is also going to be one of our speakers. We have Old Republic Home Protection. We have Christy Buscemi. Say hi in the back. There she is. And we have the lovely Citibank Home Lending, Maria Castro. And they have provided lunch today for everybody. So big thank you to you guys. I want to start off by introducing Eileen Kendall. Eileen is a civil litigation trial attorney who started practicing civil litigation in 2003 when she was an associate at Spire, Woodward, Corvallis, and Goldberg, a prominent real estate and business litigation firm in Redondo Beach. After 8 years with SWC&G, it was time for her to spread her wings. For a year and a half, she joined a solo practitioner in Irvine handling Korean FDIC foreign judgment, collection cases, contract disputes, and general litigation matters. She then spent 4 years at a national firm in Long Beach, where she was responsible for handling 30 to 40 litigation cases relating to wrongful foreclosure, bankruptcy discharge violations, and loan modification issues on behalf of loan services and lenders. In 2016, she decided to open up her own firm, Kendall Law, in the city of Torrance. Please give me a big hand in welcoming Eileen Kendall.
Good afternoon, everybody. Okay, today I'm going to talk about some legal strategies for real estate professionals to try to help you avoid litigation, both for you and for your clients. Some of the things that I'm going to touch a little bit on are how to give disclosures, representing buyers and sellers, and advertising. I'm also going to try to give you a little bit of information on the unlicensed practice of law and referral fee commission splits. Disclosures. 75% of litigation is due to disclosure problems, whether it's a misrepresentation or an omission of important facts. They can be an innocent, they can be just an ignorance of the facts, or they can be on purpose, which is fraud. In most of the cases that you will see, it's going to be based on a misrepresentation and fraud, and that's what I see a lot of in my cases. So the common items that are misrepresented when you have a seller are things like structural, roofs, leaks, plumbing, termites. So I'm going to try to break it up a little bit and give you some case examples so that you can see how it works in your practice. I have a case where the owner owned a 2-story unit. It was a mixed-use unit. The top was residential and the bottom was commercial. While the property was being shown, the bottom part was in use. She had air fresheners and other things going on when it was being shown. And at one point, we have learned that prior to the listing of the property, that owner hired a plumber to investigate an odor in the bathroom on the first floor. That plumber even did a moisture test. Didn't allegedly find anything, and nothing was done. We also have facts that show that in the top unit, she did some work on the floor due to leaks with regards to the plumbing associated with the sink in the kitchen and the dishwasher. There's a big piece of plywood on the floor, so you know that she opened up the floor and knew that there was a problem. The owner then lists the property in March of 2017, and a buyer makes an offer. On page 2 of the transfer disclosure statement, the seller marks no to the question that she's not aware to any significant defects, malfunctions of the floor, plumbing, or plumbing problems, or any other structural components. Now, it's also to note this is a HOA, and there's some common areas on the top floor to the front door. A visual inspection shows that the drains are not connected and that there's pooling of water on the patio. She also marks that she's not aware of any flooding or drainage problems. On the seller property questionnaire, the seller doesn't mention the odor or any testing. Now, I think it was about a 6-month period of time that she had that done, but doesn't make any mention of it. That's an omission of fact. And like I said, while the property was being shown, she had air fresheners running. So anybody that would come in there, and it's a salon, so you probably have a chemical smell and the air freshener smell, a common person isn't going to necessarily smell that in odor because you have so many other things going on. So escrow closes, and the buyer notices, because now the place is empty, an odor, and goes into the bathroom and does a little investigating. Kind of presses on the wall, takes a screwdriver to the wall, and I've seen it. It is severe mold. Rotted joists that we have discovered that the leaking from the common area has been going on for years. Of course, the seller says, I don't know anything, but then gives me a statement from the plumber that says, well, there was an odor and we did have it tested. But again, I'm looking at my transfer disclosure statement and there's nothing on there. Now, as a realtor, your duties, and I'll talk about this a little more, is obviously it's not something you're going to know, but it's a good idea to probably, with your seller, when you're doing a walkthrough, and I'll go over this a little more as a legal strategy, is to get an idea of what may be going on. You know, a visual inspection would have shown, obviously does show, because I've been there, that plumbing or the drainage isn't connected and that there's pooling of water. Maybe inquiring into that to see if there's something more. In the end, the buyer has brought a claim against the seller for failing to disclose and recover damages. Because had the issue
property is not seller occupied, they passed away.
So there are exceptions to the TDS. TDSs don't need, and there's a list of them. I wasn't going to provide the list. Foreclosures, you don't have to have a TDS. Probate sales, you usually don't have to have a TDS. However, that doesn't get rid of your common law duty to make a disclosure. Same even if you deliver a TDS and there's something not on the TDS, you still have that common law. Because it's 2079. Most times when I draft a complaint and I'm suing for something like the example I gave you, I'm going to sue under common law fraud and then violation of 2079.
You notice something? I mean, you're not going to get any money for repairs necessarily. I mean, because they're basically selling those properties like as is.
Yeah,
a trust owns it. Right.
They need to make that decision. They see the discoloration, even if it's not disclosed, and you're representing the buyer. Here's this number. Call that person.
Independent,
because
right?
That
Okay.
way, you made that visual inspection, and then you're advising him. I don't know what that means, but you should go check it out. And that way, if they buy it and it's, you know, $50,000 of repairs, you're not on the line for getting in trouble for not making disclosure.
And which form do we use for that?
You know, I would think that that's
Is it just an addendum?
probably
Yeah.
I think it's called I'm not sure of all the forms, but there's one that's about a visual inspection.
Oh, yeah, the Avid?
Yeah, Avid. That's it.
Okay.
That's the one.
No, but I was referring to if something comes up after the Avid. Like I had a situation 3 days before closing escrow. The house got a major leak. And of course we halted, actually it was the day before we closed escrow. So then they had to dry the whole place out, do mold remediation. It took another 60 days to close on that home. All the wires were almost like at escrow, like it was like that last second, major mainline pipe broke under the slab. So we had slab leak, and then we had to pull a whole new line. So the sellers paid for everything and took care of all the repairs. And then we did another inspection to verify post-repair, and then had somewhat of a warranty from the contractor. But that was one of those situations where the house was vacant, the gentleman who lived there passed away, and then the owners were like in Tennessee, it was a trust, and nobody was supervising the property. You know, so it was a really weird situation. It never had happened before. And we almost, the buyers still bought the property. A lot of, because they were talking about wanting to back out of the deal. And
So the form, I think, because you've already done.
yeah, we've done the Avid, right.
Is an addendum.
Right, just an
So
addendum, okay.
This is what happened, these are the repairs. These
A statement
are
of facts,
agreements,
right.
Something like that where the parties sign, you know, because, I mean, that is a different situation and you've already done the inspections.
Right. That's why I was
think
asking.
you do it as an addendum so that everybody's clear on what happened and what's agreed. You know, they agreed to make the repairs, they made the repairs, they agreed to this contract.
Right. A copy of the
Contract or warranty, and then have the parties sign them.
Right. I mean, it all worked out, but you know, everything was disclosed. We knew who the contractor was. The buyer had a rapport with that contractor.
They probably use it as an addendum.
Okay. Yeah, I think that's what we ended up doing, but I wasn't sure if we did it right. So it sounds like we did. All right. Thank you.
Basically the same thing. What happened when this 5 and more units on a building? You use the same thing?
I don't know. I didn't look into that. I don't know exactly what requirements. I know there's the CDS that required or not required. Most of them that I deal with are 149.
So on your square footage analogy or scenario, so let's say it was 200, 300 square foot difference. We don't know this, but I just had one where there was 1,540 square feet, and then the appraiser came in and said it was 1,360. We knew that there was a potential discrepancy. The seller said this is what it is, but we knew there was a potential discrepancy. So I put in my Avid, it says this, historically, it's shown this, buyer to investigate. Is that as far of a reasonable inquiry as you need to do?
Yes, because you're disclosing what you know, so you don't as a realtor, you don't have a duty to go down to the county records or the business planner. You don't have to crawl in the walls. But you obviously made a visual, knowledgeable disclosure and said, go have it checked out, and they got an appraisal that came back different. So yeah, that's definitely how you want to do it.
Question back to what you had mentioned about the TDS, and you said something about when you're going through those with your clients, that particular form you mentioned specifically. That I was wondering if you could explain that a little bit more, because I've been told you need to. That's almost like the arbitration kind of a question, like. That's a legal form where they're disclosing, and if they have questions specifically about anything they should or should not be putting on there, we need to tell you to answer truthfully, but anything beyond that is a lawyer question for that particular form.
And part of that, yes and no. Because part of it, what I kind of meant is to have an idea of the things that need to be disclosed. Because your agent inspection is kind of similar to your TDS. So you want to be able to visually inspect, and I suggested walking through the property with your client and, making notations. But yes, giving them what is the ramification if you disclose that, well, that could fall into the legal, you're giving a legal opinion. The right answer is you need to be truthful, and, if you have to think about it, disclose it. I'm not going to say that that's going to fall over the line of I'm giving you a legal opinion saying if you disclose that water leak, you could be liable for X, Y, and Z. And it's always a good idea to listen to your gut. It's better to walk away from a deal than have to deal with 3-4 years of litigation on something that could have been, you could have walked away, because there's sometimes when you're talking to somebody, you can just know that they're not being truthful. You have no control over what they do and don't disclose. And as a visual inspection, you don't see everything. But some of the stuff is just apparent. If there is a leak, obviously something happened, and they need to disclose that. And if they're not being truthful about it, kind of feel them out and have a conversation with them without, going too far into any type of opinion.
Let me get her first, and then I'll leave.
A really quick question is about TDS. So I have a property, so basically tenant occupied. It's only being leased out for 2 years, so the seller is trying to sell the house. But seller indicated that she has not too much knowledge about the property because it's being used for rental. And so
No, I mean, as a landlord, you can do a 24-hour notice to inspect, and if you're a landlord, you should be doing those pretty regularly, especially on a long-term tenant. I got a property management company that got a new property. They hadn't been in the property for 10 years, and you don't want to know what it looks like. So there's another legal strategy for you. As a landlord, you want to be doing inspections. She has control over that property. And landlord-tenant laws allow you, if you're selling the property, to give notice specifically to show the property. But yeah, she needs to go in and take a look at it and be able to disclose things about the property.
okay, one more question about photos copyright. So when we sign the hire professional photographers, so what are you trying to say is that basically what? So what are you trying to say that basically even though we pay someone else, so we have to make sure that whatever the copyrights, and after they did a photo shooting, and we have the copyrights in case there's some kind of copyright violation, right?
Yeah, so you just need to make sure the contract specifies that. Sometimes we get pictures that aren't watermarked, or, somebody that's not that savvy in how to protect their images. But if they put something in the contract that says that you're only limited to use this or this, that, the language you will want to make sure to have is that those are, you're buying the right to those photos for eternity.
So just to follow up with the two previous questions with the TDS, landlord owner hasn't been in the property, let's say 10 years, and lives out of country. How do we get a good TDS? They have no clue. They have a property management company. Can they do the TDS?
Well, the property management is an agent for the landlord. And again,
Would that be
if you
a-
have a good property management company, they're going in there at least once a year to go in and make sure that the property's in a good condition.
So it's okay to defer your TDS as an owner to like a property manager to do that? Because I have like foreign buyers or foreign sellers. They rarely, they're not going to make a special trip here. They just, everything's electronically.
Well, even if...
E-signature.
Well, you know, most of the time, the property manager is the agent for the real...
For the seller.
Have the property. They're the ones that have the knowledge. Whether or not they can sign the TDS on behalf of the seller, I don't know the answer to that right off the top of my head because it's an agency relationship that you just have to make sure that the right forms are done on the property management
Okay.
side
Okay.
for that authority for them to bind the seller.
Because the owner's
Can't
never,
make that determination without knowing that relationship.
Right.
But the property management company should know the condition of the property and
Right.
provide that information.
right, because the owner never lived in the property, maybe saw it once, and then back out of the country.
Right, and again, the property management
Okay.
managing that property
Should-
should know the condition. But whether or not the property management can sign the document depends on the relationship with the owner and the property management, and I don't know that with
Okay.
limited knowledge.
Got it, thank you.
Got a question regarding the finder's fee and referral fee. Are they the same under California law? And how about under federal law?
Well, under federal law, it's all considered the same. A referral fee and a finder's fee, you know, the case law has determined instead of it as a referral as a finder fee. And the difference would be, a referral would be, the case examples were one realtor gives a referral to another realtor in another state because their client is moving out of state. That's how the case law shows referral. And then that's going to be dependent again on the state you're going to's law. Under federal law, it's not allowed because they're doing something that's requiring a license. And a finder's fee, the case law has been very, very specific. Now, a finder's fee can be allowed to, say, I touch two people, that's a finder. The next situation, I do a finder, but then I step the line. That time, I can't get a fee if it's a cash deal. So each time, it's different analysis on the finder. And then, like I said, if it has to do with a loan, you can't pay it under federal law. Yeah. Okay. Well, thank you, everybody.
Sorry.
All right, so our next speaker is Dennis McLean, CPA. He's the founder of McLean CPAs, previously a partner in a firm in Michigan, and also the financial director of Rancho Palos Verdes. He's a faculty member at Cal State Dominguez Hills, and he teaches advanced accounting and taxation. His company, McLean Associates, they serve small business owners, especially licensed professionals like us, realtors, families, executives, not-for-profits, and startups. And if you have any questions about some of the core principles that are discussed today, he's happy to do free phone calls and email. So be sure to get one of his cards that are being passed around now. So, yeah, without further ado, we'll have Dennis start his presentation.
Well, thank you, Jesse. And thank you to South Bay Association of Realtors for having us here. No, I actually could just set it there. I've got wireless. Can everybody hear me? Yes. Okay. And I'm accustomed to a large room like this anyways because I do teach at Cal State University, Dominguez Hills. My first question, are there any tax preparers in the room? They're busy. Okay. So am I. But two, Is there anybody in the room that has filed their tax return for 2017? Okay. A few of you. Okay. Is there anybody in the room that owns rental real estate, by show of hands? That'll help me kind of guide my presentation. Good. I have two more questions. And hopefully, oh good, we do have the presentation. Two more questions. Who in the room thinks that they're going to pay more in taxes in 2018 as a result of Tax Cuts and Job Act? By show of hands. Boy. Okay. Generally speaking, what's been published is that in California, 85% of us, not me, but 85% of us will actually see a decrease in federal income tax as a result of Tax Cuts Job Act, and only about 15% will see an increase. But what it means to you, depends on your facts and circumstances, and I hope I can help a little bit today. And I'm accustomed, because I teach students at Cal State University, I'm accustomed to people. You are welcome to interrupt with any questions as I go, because I think it'll help the presentation, and I think it'll help all of us. So here we go. Tax Cuts, Job Act, what does it mean for you as members, as well as your clients? First, I'm just going to try to do an overview. I'll try to talk a little bit about what it means to your real estate industry, what it means to you as agents, and what it means to your clients, especially, notice what I plugged in there, commercial real estate. If there's any sub-segment of your industry that has been favorably impacted by Tax Cuts and Job Act, it's commercial real estate. I hopefully will have some ideas for you if time allows. And of course, my standard disclaimer that my insurance provider asked that I provide. And there's one thing that I want to point out, and actually it's so dense I can't. I'll just say it. My peers and I are learning about this tax law as we go. I have seen things published that were wrong. I have seen things published that were just plain a little bit off, okay? So the one thing that I will say to all of you, if you have a tax professional that you work with, now is the time to get together, maybe as a part of doing your 2017 tax return, or if time doesn't allow, after you've done your 2017 tax return, because correct me if I'm wrong, most all of you are real estate agents by show of hands. Many of you have rental real estate. There's a lot that's happened with this tax law that is good to you, and I want you to plan for it. So here we go. With few exceptions, all of the provisions of Tax Cuts Job Act are now effective 1/1/2018. Key point. No, it's not going to display. Sunset. Notice the word sunset. Many of the provisions of Tax Cuts Job Act are temporary. Many of them are set to expire on 1/1/2026. Will they? We don't know. Based on what I know, and as we go through this, I've got a feeling some of them will, depending on how our economy is going, tax revenues, the deficit, and what party is in place. Key words: suspended, not eliminated. You're going to see that all throughout this presentation and any discussion that you have with your tax professionals. Kind of an interesting slide, and I stole it. I stole it from Beacon Economics Chris Thornburg made a presentation in early January that I participated in, listened to. A couple things that he pointed out that I thought are noteworthy. The deficit. We've all heard about the likelihood that the deficit will grow by as much as $1.5 trillion over 10 years as a result of Tax Cuts Jobs Act. Their work seems to indicate it could be as much as $3.5 trillion. If it really is going in that direction, there's going to have to be some adjustments made. And I think we all need to realize it. So we should do what we can to enjoy the benefits of this tax act now. And there are some. But I just wanted to point out that the National Association of Realtors took and deserved credit for their lobbying effort to save the exclusion from capital gains on the sale of a home up to $250,000 for a single person, $500,000 for married filing jointly, and preserve the like-kind exchange for real property. Two very important facets. Yes.
Does that mean still remain at 2 out of 5 years?
Yes. Yes, and that actually appears in a slide, but it's a very good question. You know, the key point, the question was, you know, provided you live in, does the provision requiring that you live in that residence for at least 2 of the last 5 years, did that stay intact? And it did. Okay, your association, the National Association, is projecting slower home growth, 1 to 3% in 2018. And this point that I've seen on their website is really interesting. Some local markets, particularly high-cost, high-tax areas, will likely see a price decline. I'm not. Okay? I don't. Does anybody here see a price decline going on right now? Okay. I don't think it's going to happen as what was expected. There may be price changes in the future, but I don't think it's going to be the result of Tax Cuts Jobs Act. Okay. I'm just going to touch upon this. The Act temporarily doubles the exemption from estate and gift taxes from $11.2 million until 2025. I don't benefit from that. I just want to be really clear. And maybe some of you don't, but some of you may, and some of your clients might. The key thing is that, you know, with this doubling of the exemption, the lifetime exemption from gift tax, there is a need for some planning to be done among certain families. A flat 21% tax rate for C corporations. Okay, you know, it's really going to be, I believe, it's going to be very helpful to our national corporations. And I truly believe that one of the intents of Tax Cuts Jobs Act is working, which is to bring some cash back to our country, such as, you know, as a result of foreign earnings that have been collected and kept in other countries, now being subject to a one-time 15.5% tax. Apple took advantage of this. Okay, now to the stuff that really affects us, though. If you don't own a home in California, you're likely to see a tax decrease. Okay, if you own a home in California, and here's the key, with substantial property taxes, and if you pay substantial California income tax, you're likely going to see an increase. Okay, my wife and I, dual wage earners. Okay, we bought our home 10 years ago in Redondo Beach. Our property taxes are $9,950. Okay, we're going to get to $10,000, the $10,000 cap, which I'll talk about momentarily, like really quickly. So we are a perfect example of a family that's going to be unfavorably affected by Tax Cuts Jobs Act. But for small business, I like this. There's a new 20% pass-through deduction. It's complex, okay, that's in place through 12/31/25, and there's a lot of temporary improvements to write-offs that can reduce substantially income taxes for business, including commercial buildings. Now, this 20% pass-through deduction. You might want to write this down so you're sure to talk with your tax planner about it. Section 199A. Okay, it's complex. Okay, I don't want you to think otherwise. The limitations, the steps necessary to qualify are complex. I'm going to go through a few of those today, but it's really important, and I'll say this more than once today, it's really important for you to plan around the benefit of this 20% deduction that may be available, that may be available to you. There are professionals like Eileen, myself, and everybody in this room, okay, that have got to take great care in my belief, to try to manage your taxable income to take full advantage of the 20% write-off. We'll come back to it. Okay, I've already touched upon it, a temporary $10,000 cap on the deductibility on Schedule A, itemized deductions for California income tax and property taxes. Okay, for those taxpayers on both the West Coast, the East Coast, especially California, it's a big deal. And it kind of, for the most part, is going to make or break. It's going to make or break as to who is going to benefit from Tax Cuts Job Act. Yeah. Oh, I see. Hang on one sec. Okay. Now you've all probably heard about this next point because of what you do for a living. The limitation on mortgage interest related to personal residences. It's not as bad as what was first being conceived when this law was in motion back in November. But there is a temporary limit on the mortgage interest, Schedule A, itemized deduction, personal residences, at $750,000 for any new mortgage on a personal residence incurred after 12/15/2017. But it's really important to understand that there was a grandfather that was also put in place at the last second with this legislation that enables existing mortgage interest debt to be refinanced if possible, if necessary, to be refinanced and to not lose the benefit of the mortgage interest deduction. Okay? I'll try to say that again. And by the way, I say this to my students, if I become incoherent, stop me and just ask, okay? It's been a long tax season. I've been going 7 days a week for a month already. So what am I trying to get at here about this provision here? Grandfathers, deductions, existing debt less than $1 million. Well, the law before Tax Cuts and Job Act did limit the deductibility of mortgage interest to $1 million. For anybody that's got a mortgage before 12/15/2017, that's still the case. Anybody that wants to refinance that mortgage, they still will get the deduction, based on the amount of the debt that's being refinanced. There's
a question on that one, Dennis. Does that count too for rental properties or second homes?
It does count for second homes. Rental property is business property, and if the rental property / business property is being properly accounted for, it is not a part of the limitation. Okay, but second homes, vacation homes are wrapped in. It's actually like one bullet point down. Thank you. That's a good one. But here's another aspect of this law that was misinterpreted, and it was probably early, that is, and it's probably because home equity loans at one point were going to be repealed, period, no matter what, okay? But just before this law was enacted, there was a substantial change a home equity loan, as long as you stay under, the cap, if it's used for improvements to your residence, if it's not used to buy a car, if it's not used for tuition, if it's not used for a vacation, a home equity loan is still potentially deductible. The interest expense is still potentially deductible. Okay? And similar to your question, it still allows for the deductibility of that second home mortgage, but again, overall, you got to stay underneath that $1 million cap. Okay. I'm just going to try to race through a few of these slides. As you may or may not, yes?
How are you going to be able to get a copy of this presentation?
Yes, if there are more business cards. Okay. How about I start them over here? Just grab a business card and I'll be pleased to present, email me with the email address on the business card and I'll be glad to send this presentation to you. Thank you. Okay. Moving expenses. Unless you're in the military, temporarily suspended. Notice what I underlined. Entertainment expenses. I'm not talking about meals. I'm talking about skyboxes, tickets for events, okay, boats, okay. Entertainment expenses have been eliminated, okay. And although like-kind exchange of real property is still intact, thank goodness, like-kind exchanges of personal property, like automobiles, went away with Tax Cuts and Job Act. And again, I've already said it, the gain exclusion for the sale of a personal residence is still intact, thank goodness. Okay, now comes some of the fun stuff for business. There is a temporary 100% bonus depreciation that is now available for qualifying personal property. Okay, we've had this Section 179 write-off available, with a limitation up to $500,000, but even in front of that now, bonus depreciation, 100% bonus depreciation on personal property, not real, but personal property. So for someone that has a business that is capital intensive, equipment intensive, now is the time to start thinking about replacing that equipment to take advantage of bonus depreciation. It's a 100% write-off, dollar for dollar, through 2022, and then the write-off, the bonus depreciation declines at the rate of 20% until 2026. And again, Section 179 write-offs are still intact, okay, but have been increased from $500,000 to $1 million, again, but subject to a phase-out. The bonus depreciation is not subject to a phase-out. What you're going to find as business people, tax practitioners are going to encourage clients to take advantage of bonus depreciation first. My most favorite example is a client, I'm really referring to a client who has a physical therapy business, very machinery intensive. And with technology, they need to turn over their equipment actually pretty rapidly, okay? One of the beauties is that now they're going to get 100% bonus depreciation as they turn over that equipment as necessary. Yes?
Does that 100% bonus depreciation of qualifying property include automobiles?
No. And it appears right on the next slide. Good question. You were just one step ahead of me. Okay. There has been this concept in the tax law called listed property, luxury automobiles, limiting the depreciation of those kinds of vehicles, basically all of our vehicles, to $3,160 up until now. It's now been increased to $10,650. Okay. However, if you have an SUV that weighs more than 6,000 pounds, you do have that bonus depreciation available to it, or Section 179. Key being an SUV or a truck, whose weight is in excess of 6,000 pounds. Kind of a quirky little thing in regards to rental real estate. The Section 179 write-off now includes the write-off of appliances and other items that are inside the home without any question. I mean, the law actually cited that very specifically. But unfortunately, that's really, from my point of view, from what I see, that's really the only benefit that I'm seeing for rental real estate. Depreciation is still over 27 and a half years. Yes?
Renovation fees, included on the
I'm sorry?
renovation for the rentals?
For residential rental? Unfortunately, it is still limited, unlike commercial, okay? I wish I had good news for you, but I don't, okay? So renovations, if they need to be capitalized, if they're material, if they extend the life, improve the value, really should be capitalized. I think you're going to find that most tax practitioners like myself will probably err to the side of aggressiveness, rather than capitalize when looking at improvements, unless they're, $50,000 or $75,000. If we're talking $10,000, $15,000, we're more likely to just write it off. Yes?
Depreciation that you're talking about there, still over 27.5 years, does that pertain to your rental property?
Yes.
Now, I thought it's 30 years.
27 and a half. Yeah. Yes.
Does the Section 179 write-off, the 100% bonus write-off, is that effective date is January 1st, 2018, or in September?
The inclusion of appliances and other fixtures within the home that you can clearly break out, effective 1/1/2018. Yes. Okay. 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 I'm accustomed to otherwise, but I got you. Okay. Here is one slight twist, but unfortunately it's applicable to non-rental real estate. Okay. Now, Section 179 has been expanded to include improvements such as roofs, HVAC, fire protection, alarm, and security. But again, this is focused on commercial property. And Section 179 write-offs, okay, have been broadened, okay, to basically include 15-year depreciation of leaseholds. So if you go into a building, and if you literally clean it out, redo the leaseholds, you now have the ability to write off those, not just 15 years, but you can take advantage of Section 179. Probably a good thing for commercial property, for businesses like restaurants. And excuse me, I've been asked to hold off questions until the end so that we can record the questions and the answers. And I'm sorry, that's my fault. Okay. Okay. We're back to the 20% deduction, Section 179, for self-employed, partners, S-corporation shareholders. Okay, is there anybody in the room that's self-employed? Of course. We all are. And we all have Section 179 potentially available to us. Not as an adjustment from gross income, not as an itemized deduction. It's going to get its own line on the tax return on page 2. It really is an opportunity for you, okay? But, again, it's complex. the deduction is limited to the lesser of 20% of your net qualified business income. Basically, think of it as your share of business income with a few adjustments. If you're filing on a Schedule C, it's your net income on a Schedule C. If you're smart and you've created yourself an S corporation, it's that net income that shows on your S corporation tax return. So it's the lesser of, the benefit, the tax deduction, the 20% the tax deduction is potentially limited to 20% of your net income or 20% of your taxable income, okay, excluding capital gains or losses. But again, subject to limitations and phase-outs, and probably the most important thing you've heard me say more than once is the fact we need to plan for this, okay? If you have a good year, you may not be able to plan for this. You may not be able to get the 20% deduction. But just bear with me for a minute and see if I can coherently explain this. Okay, first of all, there's two categories. There's us, and there's all other businesses. Okay, what do I mean by us? We all fit into this category, this new category called a specific service, trade, or business. Okay, now if you have any sense of humor, this slide is kind of interesting. The code, the new law, points out that specific, trade or business, specific service, trade or business includes athletes, performing artists, and unfortunately most every professional, okay? But here's the key phrase. Anyone whose reputation and or skill is their principal asset. It's everybody in this room. It's the way I see it. Okay, but hang on. So there's us and there's everybody else, and the limitations are different for both categories. Okay? And here's the most important takeaway from my point of view for you today. Okay, the 20% deduction is limited and is phased out when your adjusted taxable income, married filing jointly, hits 315. Okay? Once you get on a married filing jointly return starting in 2018, once your taxable income hits 415, gone. Okay, so there's this really narrow window of $100,000 between 315 and 415, okay, where the 20% deduction starts phasing out. Okay, I think one of your takeaways is in terms of expenses, in the timing of expenses, as well as the timing of revenue, if at all possible, try to plan it on a married filing jointly return to keep it under 315, just under 315, and certainly not over 415. Now, if you're a single person, it's that in half, cut in half. 157,500, okay, and what is that, 207,500? Okay, those are the phase-out thresholds that you really need to be mindful of to take full advantage of the 20% deduction. Okay, no deduction. Now, what about your clients that are in business, okay, and are in a business not like us? In a business, perhaps it's retail, hey, perhaps it's commercial rental. Okay, they have limitations as well, okay, but the limitations are not so substantial. Basically, 50% of all W-2 wages paid by that qualified trade or business, or, and this is the one that will get a lot of commercial rental real estate, the sum of that 25% of W-2s plus 2.5% of an unadjusted basis of depreciable property. What the heck does that mean? Okay? Just multiply 2.5% times a commercial building that was purchased for $10 million, and that's your limitation. Okay? As an example. Okay? The limitations for the other category of businesses are not as substantial as they are for us. Okay, I'll move on. I am going to skip over this part and just touch upon a couple other things. Okay, is there anybody, I know there's a few, is there anybody in the room who is not an S corporation as a real estate agent? You are not. Okay. Think about it in the future. I really strongly encourage you to think about it in the future, becoming an S corporation. As a Schedule C sole proprietor, we are subjected to about a 14% combined Social Security and Medicare tax. Okay? It's basically, you know, the same Medicare tax and Social Security tax that's withheld from wages that is subjected based on net income to the self-employed person, okay, up to $128,400 of self-employment income. How would you like to avoid that, or at least a part of it? Okay, not everybody should. Now, let me be very clear about that. Not everybody should. But let me first go on. Likely, everybody in this room is at least subjected to a 22% tax bracket federal. Likely, everybody in this room is subjected to a 9.3% California tax bracket, maybe more. So for every dollar of income, most everybody in this room is paying at least 31% in taxes, at least. How would you like to avoid plopping another 14% on top of it? Okay. Well, the S corporation's a good vehicle for that. Whereas the income from the self-employment income is without any question subject to the 14% tax. The net income from an S corporation is not. However, you know, the IRS expects that if you are an S corporation, that you're going to pay yourself a wage. Okay? The wage needs to be fair. Okay? It doesn't have to be all of your net income. It just simply needs to be fair. So there is an opportunity for all of us, depending on our income level, and we can change our wage from year to year to, as an S corporation, to avoid paying the self-employment tax at 14% on all of our self-employment income. You know, it's just an idea that I know some of you have utilized, and it's an idea that I think everybody in the room should consider. What's the cost? Without a doubt, if you're an S corporation, you pay $800 to the Franchise Tax Board every year, you know, in annual fee. You also would probably have to pay a preparer, or maybe you can prepare your own tax return for the S corporation, but there may be the cost associated with preparing the return and doing separate accounting for your S corporation. It's something that I believe that everybody in the room should weigh. A couple other thoughts. We've talked about the Section 199A opportunity. We've talked a little bit about the possibility of forming an S corporation. I mentioned that there is that $800 tax plus 1.5% of net income. Okay. But now let's just talk about a few things about record keeping. And the first thing that I just want to remind us is any Section 162 of the Internal Revenue Service Code says, you know, any expense that is reasonable, ordinary, and I'm going to use the word necessary, is deductible, you know, from your gross income, your business income, unless specifically excluded. One of the important things, though, is don't miss your continuing education, your automobile expenses, the possibility of deducting business use of home office if you don't have an office provided to you. Don't miss legal and professional service costs as a deduction as well. I'm a believer that good record keeping is important to all of us. With our practice, one of the things that we're striving to do is to gather at least some of the evidence that go with your tax return and archive it in the cloud. Not just the forms, the 1099 forms or the 1090B forms, but just some of the best of evidence that could easily be destroyed with an earthquake, a fire, or whatever. I'm a believer that using a dedicated credit card to pay for all business expenses is really helpful when sitting down with an IRS agent. Okay? You clearly show that you've got a customary business practice of keeping your records separate from personal. Receipts, especially for meals, meal deductions are not even really available unless you have good receipts. The code and the IRS publications are very clear about that. So if you're deducting meal costs, and of course only 50% of it is deductible, you're going to want to keep good receipts. Also consider using the apps that are now available for auto mileage. Most everybody in this room, not everybody, but most everybody probably uses the standard mileage rate, which is somewhere in the neighborhood of 50 cents, 53.5, I believe, right now. With that app, you make the deduction a lot easier to track. I'm not actually going to go into this topic today, but I'm going to ask a question. How many of you, and I've asked it before, how many of you actually own rental property? A lot of you, okay? Do you feel that you're considered a real estate professional pursuant to the Internal Revenue Service Code? Okay? It's not an easy thing to satisfy, the requirements. And I didn't come prepared to walk through that. I'd be more than happy to come back another time and talk with you about that. But my only takeaway is, please be careful, because I actually worked for another CPA firm for a couple tax seasons. I watched three different real estate, three taxpayers who thought that they were real estate professionals actually go through an IRS audit, of which I don't think any of them survived the characterization of real estate professional. The standard is pretty significant, and it takes good planning and care. If you have more than one operating entity, one or more rental property, you're going to want to file a tax return that clearly makes the statement that you're combining those activities into one for the determination of whether you're a real estate professional. My only takeaway, and again, be more than happy to come back and talk about it again, is please be careful. The benefit of being deemed a real estate professional, your losses from rental activities in excess of $25,000, those passive losses are deductible. Otherwise, they're limited to $25,000. With that, I'll be more than happy to try to answer any questions that you might have, and thank you for this opportunity. Last question.
So with the home equity loans or HELOCs, if you had them before December 15th, are they grandfathered in even if you didn't use it for improvements?
If the combination of that home equity loan and other mortgages as of that point in time are still under $1 million, yes.
Okay, thank you.
Is it true that you don't need to keep the receipts if it's under $75?
I really don't know the answer to that question, okay? I'm sorry, I really don't. I would discourage that practice, honestly. I mean, receipts for $5, $3, that's parking, that's a little bit different. But boy, if it's a meal and it's $60, I'd keep the receipt.
The second question I have is I own a property in California and one in New Jersey, so is that 10,000 for California and 10,000
No.
for New Jersey, or that's a combination of both?
That's a combination of the
And it's
two.
a combination of everybody's rental properties and their own personal property, 10,000?
No, no. Okay. The 10,000, I'm glad you asked. Okay, good question. The $10,000 cap is for non-business property. Okay? Personal, as in a personal residence or perhaps a personal residence and a second home that is not business property. Business property is not subject to the cap.
So if you have rental properties, then you still get the tax write-off of the interest?
Of the interest
And the
as
taxes.
well as the real estate taxes.
Okay, thank you.
Yeah.
Does the grandfather's law, so for example, I have the home, personal residence. So basically, the principal amount is more than $1 million. And based on grandfather's law, if I'm trying to refinance, does that still qualify to deduct the interest?
Yes, whatever the mortgage balance is, okay, provided it's under 1.1 million, okay, it will still be, the interest expense related to it after refinancing will still be deductible. Yeah, that's good for you. I can tell by the look on your face.
Hi, Dennis. Thank you. Question, you're heavily saying that as real estate agents, we should all be S-Corp. And I spoke to another CPA who was recommending sole proprietorship LLC. The reason is in California, a salesperson's license, we're required to have a broker, which is an incorporation typically, and we have all the protections under our broker. And any activities we do as a licensee, we're required to operate under that broker's license and incorporation. So how is it that we could have commissions go to our S-Corp or let's say LLC sole proprietorship? How does that work from the tax, you know, for liability reasons in California, we're employees of our broker, right? But we're 1099 as far as Uncle Sam's concerned.
Okay, you know what? You've actually gone into an area that I was not familiar with, and perhaps I'm wrong. Okay, perhaps the S corporation is not available to you. However, I'm not going to dismiss the possibility just based on the exchange that we've had. Okay, correct me. I mean, I've heard two things that were said. One, you're employees of your broker.
Well,
I don't think so.
no.
I think you're independent
You're
contractors.
an independent contractor as far as the tax code. But we are employees under liability. How do you say it? You know, with our license, right?
Well, you're under your broker.
We can't operate as a real estate agent
Workers'
without a
comp,
broker.
it's for workers' comp that you are an employee only,
What about E&O?
not for E&O. You have a contract with your broker as an independent contractor. It's only workers' comp that demands that your broker treat you as an employee for workers' comp payments.
So that's the confusion I have. I need help.
Okay. And you know what?
Because I'm getting two different takes on.
No, you're getting two different takes about the LLC sole proprietorship, which is, I think, a personal preference of another professional. Okay? I think that's very different than, you know, what I was understanding is because you're an agent, okay, you're not able to take advantage of being treated as an S corporation. I am not so sure that that's, okay. Okay. I do as well. Okay.
I have an S corp, and I just have the broker pay my S corp, and I just pay myself a payroll, and it works out that way. But why is it on an S corp that brokers don't have to report to the IRS how much I make, and I don't get any 1099, and they're not required? I think that's so interesting when you have an S corp.
I don't know the answer to that question. I've actually.
Does anyone else have any other questions?
I've actually seen, if I could just finish, I've actually seen 1099s issued to S corporations by other payers. Okay. I believe that's a one-off. Any other questions? Well, thank you.
Before everyone leaves, I just want to let you know that we have an upcoming YPN event in the month of April. The date is not set yet, but it's going to be a really fun mixer. And we have a costume contest going on for Dress as Your Best 80s Realtor. There will be prizes. So we hope to see you, and thank you all. Have a good day.